Hi guys, welcome back. Today we'll be looking whether the INVESCO QQQ Trust Fund Series 1 and whether it's a good growth ETF stock to buy right now. Also, if you do enjoy, consider subscribing. It doesn't cost you anything and it helps me a ton. If not, thanks for watching anyway. Onto the video. So what we will be covering today, we'll be covering whether Invesco is a buy, looking at the positives and the negatives of this stock, the top holdings of the Invesco and the industries that they focus on, the technical analysis, the trend lines, and where this company will be going in the future, and the entry price if you do choose to buy this ETF. So about this ETF, it's a high growth ETF focusing mainly on tech stocks in the US, but also other high growth stocks in the US as well. It consists of the 100 largest non-financial stocks in the market and is up 47.5% in 2020, showing it is a very good growth ETF. So the pros of this company. So because it's an ETF, it does have an element of safety because it has some sort of diversification, but it still focuses on the high growth and maintains this, as we'll see later on in the pros. It has a low expense ratio of 0.2%, which is pretty good for an ETF. It's more than double the market in 2020, going up more than 47.5%, while the market was up close to 20%, showing that yes, it is a good growth ETF to buy. It's more than double the US market and is 27.2% undervalued according to Simply Wall Street analysts. Its PE ratio is 3.7, which beats the industry comprehensively, the US consumer ETF industry by which was 26.5, and the US market of 30, showing that it is trading at a very good value compared to the stock price. The stock price right now is about $319, showing that you'll basically make back your money in about 3 to 4 years. Its PB is 1.1, which beats the industry of 5.3, showing it has a good amount of assets. And the earnings have consistently increased from about $1 or $2 billion in 2016 to more than $40 billion now. And although revenue has gone slower from about like 500 million to $1 billion, it does show that the investments that they are making have been highly profitable. And we look at that later on when we look at their holdings. And due to this low revenue, high earnings, it shows that this net profit margin has been greater than 1,000% on a regular basis for the last 6-7 years, which is really good for this ETF. Moreover, the companies that it focuses on are more well-structured companies with a good growth story rather than just a company out of nowhere that many people are just flocking to, which gives it some sort of safety as well alongside the diversifications. The earnings have grown significantly by 44.2% per year over the past 5 years. So this is compounding per year. So this smashes the S&P 500, which approximately returns 10% compounding a year, while this does 44%. So this has amazing return on investment. Its return on equity is good of 30%, showing that it uses its revenue and shareholders' equity to a very good standard. And with this revenue set to increase in the future, you could expect this earnings to increase at a very high rate as well. It's very good financially because its assets comfortably overcome their liabilities. They also have no debt, which is good, and is rated second out of 325 out of the large cap growth funds based on the total return over the past 15 years. So this has a good past track record as well, and it looks like it will continue this in the future. The cons of this, it's not a very diversified ETF, although it is an ETF and owns 100 companies. The top 10 companies make up 50% of the holdings, and this generally means that like news that would affect the top few companies could heavily impact this ETF. So although it provides some sort of diversification, it's not as diversified as you would want for an ETF. And due to that, it has a higher volatility than the rest of the market, which is once again not something you're looking for an ETF. It has a low dividend yield of 0.52%, which is some of the lowest in the US market. So if you're looking at dividend, this is not a very good investment. And I feel like the dividend is kind of a waste because they are not giving enough to make a meaningful impression on shareholders. So I would put this dividend as pretty terrible. Their holdings. So you could see the top 10 sectors in the INVESCO QQQ fund. 63% technology, 24% consumer cyclicals, and healthcare is 6%. So you can very clearly see that the top three very much kind of dominate the portfolio. And that's what I meant by it's not very diversified in terms of the type of companies that it goes for, because it's very high growth, high market cap kind of companies. And if you look at the bottom, that kind of like reinforces that. Apple, high growth, high market cap. Microsoft, lesser growth but good market cap. Amazon, very high growth, very high market cap. Same with Tesla, Facebook, and Google as well, Alphabet Inc. And that's what I was mentioning previously, where the top 10 holdings make up 51.19% of the entire portfolio, showing that it is not very diversified, but still has very strong companies. The thing that I really like about this ETF in comparison to a lot of other ETFs is that this other growth ETFs in particular is the fact that this company doesn't go chasing around high growth stocks. So you wouldn't see this company holding Neo or Fiverr or companies like that, because those companies, although have very high growth, they don't have the market cap to back this up. So because this ETF very much focuses on high growth, high market cap, it really kind of solidifies that there will be growth in the future, because these companies are so big and so well rounded and have good management. And because of this, you could see that all of these companies in the top 10 holdings have amazing track records in the past, and continue to do so, and will have amazing track records in the future as well. And that's what I feel like really sets this apart from a lot of generic ETFs that focus on growth. So if we look at the 5-year trend, you can clearly see from January, February in 2016, it was about $100. January, February 2021, it's $319. We can see this is a very consistent uptrend, and it's reaching new highs. You can see the stock price is much higher than the 20-day, 50-day, and 200-day simple moving average. But I wouldn't necessarily be too worried about that, because it is a 5-year trend. So if we look at the 1-year trend, you could see this much better. The price is more in line with the 20, 50, and 200-day simple moving average. And over the last 7 to 8 months, this company is kind of traded in between the green line of resistance and the red line of support. So we can see currently it is at the green line of resistance, and it looks like it will come back down to the red line of support. And a buy would be anywhere below the 50-day simple moving average of $300, and in between the red line of support. If it goes below the red line of support, it would no longer be a buy, because that would signal a downtrend. And if it goes above the green line of resistance, I wouldn't give it a buy necessarily, because the stock price will shoot from there, showing and it would become less of a good value investment from that scenario. So a buy would be anywhere between $280 to $300. I wouldn't bet money on having it come down all the way to 280, as it looks like a very good uptrend. So anywhere around $300 would be a very good buy for this company, for this ETF. So just some final words. It's a very high growth ETF with a solid track record in the past, continues to do so, investing in good companies that provide good returns and have solid bases. And this basically ensures that this company will do very well in the future. It is holding good companies with good future growth potential and have well-established names, which sets it apart from a lot of other growth ETFs, that this company only invests in high market cap, high growth companies. However, due to this, it has less diversity, and their dividend is very low. But I would look at it more as like an extra plus instead of a bad dividend, but still necessarily not a very good dividend in any sense. I would give this a buy at around $300, which is just a few percentage drops from where it is right now. And given the fact that it recently hit a new high, I would look like this stock would come back down, and I would say that would be a pretty good time to buy this stock. But as always, do your own due diligence before making any financial decisions. Thanks for watching, and I'll see you in the next one. Bye.